Hello financial fans, welcome back to another stock analysis. Today we'll be covering Microsoft stock ticker MSFT. Microsoft is a global technology corporation with a wide range of offerings and services. They develop, manufacture, license, support and sell computer software, consumer electronics and related products. Microsoft is renowned for its flagship operating systems such as Windows, which powers millions of computers worldwide. They also provide productivity software such as Microsoft Office Suite, including popular applications like Word, Excel, and PowerPoint. Moreover, Microsoft is a prominent player in the field of cloud computing, offering services through their platform called Microsoft Azure. Azure enables businesses to build, deploy, and manage applications and services using Microsoft managed data centers. This cloud infrastructure allows organizations to scale their operations efficiently and securely. In addition to software and cloud services, Microsoft has expanded its reach into consumer electronics. They design and manufacture hardware devices including widely recognized Xbox gaming consoles, Surface tablets, and accessories like keyboards and mice. Beyond these core areas, Microsoft invests heavily in the research and development, exploring emerging technologies such as artificial intelligence, machine learning, and quantum computing. They also have a presence in the enterprise software market, providing solutions for businesses across various sectors. The company is currently sitting at a market cap of $2.4 trillion, and the revenue in 2022 was sitting at $198 billion. And dividend yield is currently sitting at a nice 0.87%. 26% of the revenue comes from server products, including Azure, 25% from Office products, 16% from Windows, 9% from gaming, 6% from search, 5% from LinkedIn, 5% from enterprise solutions, 5% from devices, and the remaining 3% from various other income streams. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 25% that can never be below 0%. The margin of safety can either increase or decrease based on the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has gone up over the years, going from $27.5 billion in 2013 to $83.4 billion in 2022. The average EBIT growth during this period was 13.7% annually, which is a 5% deduction from margin of safety. The margin has also gone up over the years, going from 35.3% in 2013 to 42% in 2022. The average growth in margin during this period was 2.2% annually, which is another 5% deduction from margin of safety. The next two metrics that we'll be looking at are the dividend growth and the payout ratio. The dividends have grown very nicely over the years from Microsoft, going from $1.12 a share in 2014 to $2.72 a share in 2023. The average dividend growth during this period was 10.4% on average, which is a 10% deduction in the margin of safety. This with a nice payout ratio only sitting at 28.83%. In this case, another 5% deduction from margin of safety. The final two metrics that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. Since you can see on the top left corner that the cash position of Microsoft is currently greater than the debt position, this ratio is 0% because Microsoft has no net debt, which is another 5% deduction in the margin of safety. The return on invested capital for Microsoft is sitting at a very high, almost 26%. Indicating that the management is very effective at allocating capital, which awards them with another 5% deduction from the margin of safety. Looking very good so far from Microsoft. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model we'll be using is the discounted cash flow model. I've imported the free cash flow of Microsoft going from 2014 to 2022. The average growth rate in the free cash flow during this period was 12.31% annually, and I'm projecting an expected growth rate in a future free cash flow of 10% over the next 10 years. With this percentage, we can determine the future free cash flow for Microsoft and determine a terminal year of valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $1.9 trillion, and to get our equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $1.94 trillion. Dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $261.33, which is a 19.36% downside from the current price. The second model we'll be using is the dividend discount model. I've imported dividend payouts of Microsoft going from 4 years ago to the current year. The average growth rate in the dividends during this period was 10.27%, and I'm projecting expected growth rate in all of their future dividends of 8%. I will once again be using a discount rate of 8.5% in this valuation, giving us a dividend discount model price per share of $587.52, which is a massive 81.3% upside out of this model. The third model that we'll be using is Graham's advised valuation formula. In this model, we take a look at the earnings per share that Microsoft is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation of the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory of Benjamin Graham that a PE of a company with no growth is always sitting at 7. Looking at all of these metrics, we get a fair value of this model of $184.60, which is a 43% downside of this model. The next model that we'll be using is the multiple valuation. In this model, we take a look at similar companies to Microsoft, take a look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 33.84. To get a fair value of this model, we then have to multiply by the earnings per share that Microsoft is generating, which is $9.23 a share, giving us a fair value of $312.32, which is a 3.62% downside of this model. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metrics that we use to determine this are the dividend yield and the PE ratio. In this case, I've imported the dividend yield of the past 5 years, and on average it has been sitting at 1.24%, while the current yield is sitting at only 0.87%, indicating that it's currently overvalued on this metric. Doing the same with the PE ratio, the average PE ratio has been sitting at 28.48. While the current PE ratio is sitting at 35.16, indicating that it's once again overvalued on this metric as well, giving us a fair value of $244.95, which is a 24.41% downside out of this model. If you want to get access to all of the models that I use in my videos and much more, you can check it in the description for my Patreon link. Anyways, again, that's all promotion out of the way. Let's go look at the final overview of a valuation next. Looking at a final overview, we've imported the discounted cash flow, discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $318.15. A margin of safety we've determined earlier, using a standard margin of safety of 25%, deducting it by 5% for the debt to EBITDA, 5% for the EBIT growth, 5% for the margin growth, the return on invested capital, and the payout ratio, and a 10% deduction for the dividend growth, leaving us with no margin of safety at all. In this case, then, the fair value is the same as the average out of all of our models, and with the current price of $324.07, we get a downside of 1.83%, indicating that it's currently trading very close to our fair value that we got out of our models, indicating that it's currently a hold. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.